Not all stock split stocks have the same prospects, as evidenced by these recently completed splits. Welcome to Money and Investment, where your financial future starts today. Ever wondered why starting to invest when you're young is a game changer? Let's dive in. Investing in the stock market might seem daunting, but it's a powerful tool for building wealth. Why? It's all about time and compound interest. Starting young means more time for your investments to grow. Think of it like planting a tree. The earlier you plant, the longer it grows and the bigger it gets. Worried about risks? The earlier you start, the more time you have to recover and learn from market ups and downs. And if you're starting at 50, no worries. It's about choosing the right strategies suited to your stage in life. While Wall Street is understandably captivated by the long-term prospects of artificial intelligence, AI, with PwC analysts estimating that AI could contribute $15.7 trillion to the global economy by 2030, the recent enthusiasm for stock splits has significantly contributed to the rise of major stock indexes to record highs in 2024. A stock split is an event that enables a publicly traded company to change its share price and outstanding share count by the same factor. It's important to note that these changes are purely cosmetic and do not impact a company's market capitalization or its fundamental operating performance. Since consumer goods giant Walmart kicked off the trend with its 3-for-1 split in late February, over a dozen high-profile companies have followed suit, with nearly all opting for forward splits. These forward splits aim to lower a company's share price, making it more affordable for everyday investors who may not have access to fractional share purchases through their brokers. While many of these class of 2024 stock split stocks represent leading businesses in the market, their outlooks can vary significantly. As we move into November, one unique stock split stock emerges as an exceptional bargain, while two others should be approached with caution. Investors can leverage this legal monopoly for potential long-term gains. While most investors tend to favor companies that implement forward splits, the standout reverse split of 2024 is a unique stock that presents a solid buying opportunity in November. This refers to Sirius XM Holdings, the satellite radio operator that executed a 1-for-10 reverse split as part of its merger with Liberty Media's Sirius XM tracking stock, Liberty Sirius XM Group, right after trading ended on September 9th. Companies often undertake reverse stock splits to prevent delisting from major stock exchanges. What sets Sirius XM apart is that it was not at risk of being removed from the NASDAQ exchange. However, it has fluctuated between $2 and $7 per share for over a decade. Since some institutional investors shy away from stocks priced below $5 per share, this split aims to re-establish SiriusXM's presence among Wall Street's top money managers. One of the most attractive aspects of investing in SiriusXM is its status as a legal monopoly. While it continues to compete for listeners with traditional radio operators, it is the only company that holds a satellite radio license. This exclusivity enhances its long-term pricing power for subscriptions. Another important factor that distinguishes SiriusXM is its revenue generation model. Unlike terrestrial and online radio providers, which primarily rely on advertising for income, SiriusXM has only generated about 20% of its net revenue from advertising in the first 9 months of 2024. While advertising works well during prolonged economic growth, it can pose challenges when businesses cut back on their marketing budgets during downturns. In contrast, SiriusXM has derived nearly 77% of its $6.5 billion in net sales this year from subscriptions. This subscription model provides a reliable cash flow, as subscribers are significantly less likely to cancel their service compared to businesses that may reduce their advertising spending at the first signs of economic challenges. Moreover, SiriusXM presents an attractive value proposition with a market-leading 4% yield. Shares are currently available at just 8 times forward-year earnings, which is very close to an all-time low multiple in its 30 years as a public company. This artificial intelligence leader raises more questions than it answers, and that's concerning. However, not all stock split stocks are worth considering for purchase in November. One stock that investors should avoid is Supermicro Computer. a specialist in customizable rack servers and storage solutions. The company executed its first-ever 10-for-1 split following the close of trading on September 30th. To be fair, Supermicro has had some impressive achievements over the past year. In fiscal 2024, which ended on June 30th, the company saw a remarkable 110% increase in sales, reaching $14.9 billion, and it expects revenue to grow further in the current fiscal year, projecting figures between $26 billion and $30 billion. The driving force behind Supermicro Computer's growth has been its customizable rack servers that integrate NVIDIA's highly sought-after graphics processing units, GPUs. Companies eager to take advantage of the AI revolution have demonstrated a willingness to invest heavily in the infrastructure required for success. However, this previously high-flying AI stock has faced challenges. In late August, prominent short seller Hindenburg Research released a report accusing Supermicro of accounting manipulation. Although the company has denied these allegations, it has since postponed the filing of its annual report and is reportedly under an early-stage investigation by the U.S. Justice Department, according to the Wall Street Journal. To complicate matters further, Ernst & Young resigned as Supermicro Computer's accounting firm last week. Given that Ernst & Young had previously expressed concerns regarding Supermicro's internal controls, this resignation adds weight to Hindenburg's allegations. While I won't make any judgments about Supermicro's accounting practices, it's clear that the company's stock should be off-limits until these issues are addressed and its annual report is filed. Additionally, Supermicro is heavily dependent on its suppliers, particularly NVIDIA, to fully capitalize on its AI opportunities. With a backlog of orders for NVIDIA's AI GPUs, there is a genuine risk that Supermicro Computer may not reach its full potential. This valuation premium clearly signals a recommendation to avoid. The second high-flying stock split stock that savvy investors should steer clear of in November, and likely for a long time thereafter, is MicroStrategy, an AI enterprise analytics software provider. The company's board announced a historic 10-for-1 forward split in July, which was implemented after trading closed on August 7th. While MicroStrategy has generated revenue primarily through its software division for decades, a significant portion of its $50 billion market capitalization is linked to its Bitcoin BTC 0.24% holdings. As of September 20th, it held 252,220 Bitcoin, representing 1.2% of all tokens that will ever be mined. However, there are three significant flaws in MicroStrategy's operating strategy that cannot be overlooked. The main reason to avoid MicroStrategy is the unjustifiable valuation premium attached to its Bitcoin portfolio. As of late October 31st, the price of a single Bitcoin was $69,362, valuing MicroStrategy's crypto assets at approximately $17.56 billion. However, Wall Street currently values the company's Bitcoin holdings at $49 billion, assuming a $1 billion valuation for its software division. There's no valid justification for paying a 179% premium over the current Bitcoin price. Additionally, MicroStrategy's approach to acquiring Bitcoin is highly risky. The company has financed these purchases through convertible debt offerings. While it anticipates an annual interest expense of only $34.6 million on its more than $4.2 billion in total debt, it has already burned through $35.7 million in cash from operating activities in the first 9 months of 2024. This raises serious concerns about MicroStrategy's ability to service its debt. To make matters worse, MicroStrategy has outlined an ambitious plan to raise a staggering $42 billion in capital over the next 3 years for Bitcoin purchases. This includes issuing $21 billion worth of stock through ongoing at-the-market offerings, which would dilute existing shareholders, along with another $21 billion in fixed-income securities. Adding to the challenges, MicroStrategy's only source of operating cash flow, its AI enterprise analytics software segment, has experienced a double-digit decline in sales over the past decade. Overall, MicroStrategy exhibits all the signs of a bubble that is poised to burst. Ready to start your investment journey? Explore our channel for more insights on making smart, informed investment choices. Remember, it's never too late or too early to start investing in your future. Join us at Money and Investment. for more tips and tricks on building your wealth. Subscribe and turn on notifications so you don't miss out.